Hello, everyone. Even with clarity around last night's federal election, the world is still an unstable place. And it's really tough to see where we're going to be 1 year out from now. The markets like predictability. They like stability. They like visibility. And today we're looking over the horizon and there is a fog. And that's why we've seen asset prices come down, whether they be in real estate or in equity markets. But where are we going to be? And in periods like this where it's tough to see ahead, I lean on one indicator that measures the U.S. consumer sentiment. It's really a gauge on whether Americans are feeling optimistic, negative, or somewhere in the middle. And the University of Michigan has been studying this for the last 50 years. So we really have a good sense on how the wave of collective emotion flows. Let's have a look at the chart. What we can see is that the mood is hardly constant. It oscillates from optimistic to pessimistic to optimistic to pessimistic every few years. Okay, Bryan, interesting. That's great. But how does this relate to our portfolios? What we observe is that 12 months after the bottoming of confidence, the stock market is higher than where it was. And in fact, it is substantially higher than where it was. Let me say this another way. When the fog is thickest and our confidence is lowest, is in fact an encouraging sign for stock markets. Let's run through the low points over the last 50 years, and I'll let you know how the S&P 500 did 12 months out. And as we go through it, see if you can remember the crisis that took place at that time. In February 1975, the S&P 500 was up 22% following the sentiment low. That was Watergate and stagflation. 12 months after the May 1980 low, it was up 20%. That was inspired by the OPEC shock and stagflation as well. October 1990 was up 29% a year later. The Gulf War and recession brought us that low in confidence. March 2003, the stock market was up 32.8% following the dot-com bubble and Iraq War. October 2005 was up 14%. Hurricane Katrina brought us that sentiment. November 2008, the stock market was up 22%. I don't think any of us can forget that housing crisis in America. August 2011, it was up 15.4%. That was the U.S. debt ceiling crisis, where they also got downgraded from AAA to AA+. And who can forget April 2020? It went up 43.6% afterwards. Of course, that was the pandemic. June 2022. That low was a result of inflation. Remember that? 7, 8, 9% inflation, where interest rates jumped from 0 to 5%. This one is near and dear to my heart because we shot a video at this point in time when consumer confidence was the lowest it had ever been on record. History told us that better days were ahead, and we were rewarded with a 17.6% increase 12 months later. Today, we are at another low in confidence. Could it go lower? For sure. But what 50 years of data tells us is that when we reach these lows in confidence, the stock market is higher 12 months out. It tells us that we need to stick to the plan and not make any rash decisions. We don't know how this crisis will resolve itself, but it will. That's what history tells us. If you have any questions, feel free to reach out.